Good evening. Good evening, ladies and gentlemen. I hope everyone's having a fantastic week so far. And thank you very much for joining us on this week's midweek market review or monthly webinar that we host on behalf of ATFX in partnership with them, as they are the preferred broker for ITA. Just want to quickly provide you with a brief overview and introduction, and then I'll do a sound check with you all to make sure that you can hear me loud and clear. Can everyone see my screen? Currently it's showing as black, just to confirm. A couple of yeses, that would be great. Awesome, thank you Tim, thank you Ivo. So let's get going. So Intelligent Trading Academy will be hosting this week's review via ATFX in partnership with them. 3 fundamental rules, and of course we'll touch upon them during the webinar as well. But primarily we want to show you how to learn the financial market through price action and market structures, as well as of course chart patterns in this evening's analytical session. We're looking to analyse the charts with you as well, and ultimately see if we can exploit any of the abundance of opportunities that are presented to us within the financial markets. Now, before I do, a little bit about myself. My name's Kevin. I've traded the financial markets now for coming up to 15 years, but I'm in my 14th year. I primarily trade utilising simple and structured trading strategies which are evolved from market structure as well as the nature and price action. So does everyone understand, and can anyone differentiate or answer for me what market structure is, what nature is, and of course what price action is? I'm guessing the latter of those 3 everyone will be able to understand in some form. Yep, completely correct there. Market structure is, in my opinion, is primarily about how we're utilising chart patterns in their highest probability of form, combined with basic Elliott wave theory. Now, the nature is in terms of how it approaches particular levels. Does it approach it impulsively, or does it approach it correctively? Now, I'll show you when I delve into the charts a little bit later throughout this session the differentials between an impulsive candle and a corrective candle, utilizing the 80-20 rule as well. So with us, what you'll tend to find is we focus on probabilities and percentages. We're not here to provide you with any get-rich-quick schemes. We're here to show you, 1, how to trade correctly, 2, understand the markets and typical conditions that we go through throughout the particular market cycles. So hopefully you will enjoy it. Going back to myself, I've worked within wealth management companies, inter-dealer brokers, which are part of the top 4. I've owned a proprietary trading company, and I set up a global fund, or I set up my own fund in 2016 with my business partner Adrien, who runs ITA alongside myself. And we've also worked for a global fund manager in Australia, based in Melbourne, St Kilda, where we operated as trader analysts and managed an account in excess of 100 million sterling. We're members of the CISI. I'm qualified in investment, risk and taxation. I'm also a qualified technical analyst, and my main areas of interest and enjoyment, and what I actually actively practice and preach, are risk management, technical and fundamental analysis, which I class as fusion analysis, as I fuse the pieces of analysis together, and of course psychology and mindset. I actively practice and preach psychology, yoga, meditation, affirmations, daily goal setting, and of course your quarterly plans and forecasting in the financial market. So what you will find with us is we're very, very prepared. We're not haphazard, because if we're approaching the markets in a haphazard way, we tend to have haphazard results. Now, we know, based on our top-down analysis, the watch list that we're going to be looking at for the month, breaking it down into the weeks, and then of course focusing on a few of the major pairs that we're interested in, and then of course a couple of wild cards. But let me talk about Adrien. So Adrien's my business partner. He's actually traded in the financial markets for over 25-30 years now. He's got an extremely institutional approach, as he was primarily a market maker and trader for some of the top tier investment banks such as Societe Generale and Credit Suisse. He personally managed accounts in excess of over 250 million and took a book from around 200,000 profit in the year to about 5 million profit in the year as well. He's a member of the STA, so the Society of Technical Analysts. He's extremely disciplined and consistent. He's got a more of an old school approach to him, so he's primarily, when he started and actually passed his securities exams back in 1991, he used to trade primarily through looking at huge pieces of analytical data, a huge book of analysis, trying to establish the pricing of a stock and making a market out of it. When they started to introduce the screens and technical analysis, he actually then was one of the first pretty much to move into that field and start homing in. So he loves the 200 exponential moving average, as he believes it's an institutional level that many of the big firms and top tiers focus on. And he has actually taught at the London School of Economics and, of course, helped delegates pass their exams with the STA. Now, what we've done to mirror that is we've actually created our own ITA diploma that has CPD accreditations, and as we are a CPD member as well. Adrien focuses on specifically educating our community and our top traders, as well as their mindset, and focusing on risk management as well. So a lot of the stuff you'll be seeing this evening, if I do talk about a trade, please note we actually risk no more than 1% on a particular trade, and we're always looking for decent risk to reward ratios of at least 2 to 1, 3 to 1, 4 to 1. Leading out of May, coming up to obviously May, we pretty much had a 12% return on investment for May, so the community. Some of our communities had some greater. One of our top clients, a lady called Liz, turned a yield of about 9.5% this month to date. So the markets have been very, very good, and what we're actually starting to see is the cycle of the market move from a very corrective distributing market into a market that's showing some decent impulses and some great opportunities. So let's take a look into what we're going to be focusing on. Now, I always like to cover a very, very small snippet of psychology and mindset before I ever delve into anything. Now, the reason that is in our opinion, it takes about 60 to 70% of a trader's mindset to become or considered a successful trader. That tends to take up the biggest element of your own success. We then potentially on a hierarchy look at 30% risk and money management, and the least important, which many new traders believe is the most important, is your trading strategy, which only equates to about 10% of a trader's success. This is typically how a trader thinks. They always think that an indicator is the one that's going to provide them with the holy grail or the success rate that they desire and require from the markets to get out of the rat race or escape the rat race. But I don't encourage that. Entrepreneurs have additional income streams, and as a trader we can create opportunities and yield 5 to 15% returns per calendar month without having to leave our careers, our jobs. We have responsibilities, we have a lot of liabilities, and we have families, friends and loved ones to care for. So until you're completely ready, never jump into the water with 2 feet. Test it. Make sure that you can generate consistent returns PCM before you go off and actually do this full time, because good trading is boring, and once you actually get in front of the screens, if your trading plan doesn't match your full-time work ethic, you'll find yourself over trading, getting FOMO, which is fear of missing out. Then they focus on entries, they focus on trades management, stop loss and exits. If you actually look at how trading is meant to work, you look at entries, stop losses, exits, risk management, correct, but you also have trade management and continuous learning. Yes, this is live, Miro. I'm hoping that it's up to date and you're not seeing anything as a lag, but I can only apologize if the Wi-Fi isn't shooting across as quickly as possible. But in order to understand the markets, we need to understand our own mindset and our own edge. If you can't manage your mindset and manage your psychology and manage what you've got in front of you, your go-to setups, your trading plan, your journaling, and ultimately the processes are the key in order to becoming successful and actually becoming an independent trader that's got the ability to create profits per annum. You've got to remember that the hedge fund industry or the institutional industry will look to make an average, well, if you looked at returns on the 2018 annual scenario, I think the average return was about 6% for the year. Now, if you think about it in that respect, you don't have to do much to turn a better profit. However, subject to capital requirements, subject to investments. It is always a little bit harder to do. And of course, so many new to medium intermediate traders focus on the monetary values rather than the percentage values, guys. Now, £1,000, if you do 100 quid in that month, that really is sensational. It's 10% gain on your initial account. Compounded returns will seriously excel you to become a greater trader quicker. But what you've got to do, guys, is you don't need to focus on the notional amounts that you're trading with or the notional values that you see in terms of the returns. Focus on the percentages, because when you become a professional trader, people that are interested in investing in you aren't necessarily interested in your cash returns. If they're the right investor, they should be looking at your drawdowns, your risk metrics, and of course the percentage returns you're doing consistently per calendar month. They're not interested in 150, 200% returns a month. They're interested in consistent, stable returns, and they're interested in strict money risk management to ensure that your capital and their capital is downside protected as much as possible. Okay, guys? So, without further ado, I've done pretty much all of the exciting slash menial stuff for some of you. Let's now take a look at market structures and chart patterns. And what I will do, after I've gone through and provided you with an overview of market structures, we're then going to take a look at the screens and actual charts, and we're going to start looking at the pieces of analysis I've put together and trying to plot some areas. I'll then bring it back to a cheat sheet. I call it the ITA price action cheat sheet. If you do want to get your hands on a copy of the ITA price action cheat sheet, drop an email to info@intelligenttradingacademy.com and I'll happily send you over a PDF copy of this so you can print it out and put it up on your walls or save it on your desktop so that you can have an easy reference guide to some of the most viable and functional pieces of price action and candlesticks actions that you can get to grips with and actually know and understand. Tim, I'm not entirely sure why you can't see the public chat. It is available and I have commented on it a couple of times, so I do apologise if you can't see it your end, Tim. Have a quick play around if you want to, but try not to deviate too much with your attention. I'd like as much attention as possible into the charts because it can get somewhat complex and I don't want to leave you behind. But have a quick look around the sidebar elements, as I know there is a little chat box that we can pull out. So, market structure and chart patterns. I touched upon it a little bit earlier and a couple of you guys were kind enough to reach out and answer. Now, I focus primarily on chart patterns, but some of that is made up of framework through Trendlines. Now, Trendlines are one of the most underutilized tools within technical analysis, and for us and our community and several of you traders that are in the group this evening, they do create the framework to our trading strategies. Some traders draw them incorrectly, and if they're drawn correctly, obviously they can be extremely accurate. Unfortunately, many traders or investors do draw them incorrectly. What you tend to see is traders try to make them fit with their bias, their markets. Now, can anyone quickly answer for me, how do you draw a trend line correctly? Now, I'm going to give you a poll in that respect, and I'm not going to pop it on the screen. I'm just going to answer it for you guys. In terms of trend lines, do you attach the points or trend line marks to the wicks or the upper or lower edges of the body of the candle? Daniil, completely correct. 3 touches from 2 points. Now, let's just clarify something here. Daniil's put a great answer into the group, along with Cecile, Daniel, and Miro. Great, fantastic. Daniel, just to clarify, the body is not the correct way to draw the trend line, but I'm not here to call you out, mate. I'm just here to help you and guide you as much as possible and evolve as much as possible. Now, whilst the body shows a true representation of the opening and closing price, the wick, also known as the shadow, is a true representation of where price has traveled or been. So we will always utilize the wicks unless under unusual circumstances. So increased volatility where a particular candlestick has gone parabolic, where we'll see lack of liquidity, not that much volume being flooded through the market, but the candlestick shows a 300-400 pip move, and then it closes as a doji, and I'll clarify and show you what a doji looks like a bit later. But when a wick is about 100-200 pips long, sometimes it's okay to negate that particular wick and draw through it, connecting the most important recent two touches of that structure. Now, in an uptrend, the line is drawn along the bottom of price action with easily identifiable support areas, which are also known as valleys, and a downtrend line is drawn along the top of the price action with easily identifiable areas as resistance, which are also known as peaks. So there are three types of trends: uptrend, downtrend, and sideways. Sideways is also known as a phase of distribution, or a range-bound market, or a corrective market as well. So just make sure that you understand the differentials: uptrend, downtrend, correction, sideways, distribution, because in all fairness, whilst the market is trending sideways, subject to your top-down analysis and timeframes you're trading on, we can and will exploit opportunities on the intraday timeframes, such as the 4-hour and the 1-hour, if we're looking for a short-term swing trade for 3-4%. And I'll show you how we do that as well. But trend lines are one of the most underutilized tools as well, so we must ensure that we know how to draw them correctly. And Daniil put it in a question, obviously because the chat box isn't showing, guys. I'm not entirely sure how, why. I'm a tech whiz, but in terms of this particular data and what you're seeing, I have got that clicked, and so it should be showing. So how do I draw a trend line? When I forecast the markets, when I forecast my smart market structures and my trend lines, if I can see the most prominent areas of the recent two touches, then that's where I'll be extending the trend line through the price action of the wicks touching, to make sure that I'm forecasting a third potential touch of the market structure. Now, there's a couple of ways to look at support and resistance trend lines. Some traders will look for the break of that to ensure they're taking the breakout. And then, of course, some of them will be looking to buy that support or sell that resistance subject to the gain. Now, this is one of the biggest areas what a lot of traders come to. Why do they call it a zero-sum game? Many of you feel free to answer if you do want to, but the reason they call it a zero-sum game is because at that particular moment, breakout traders are looking for a breakout continuation to the upside or to the downside. And then, of course, the guys that are looking, the guys or girls, apologies, that are looking to buy support and sell resistance are on the other side of that trade. Now, what that means is that the other side of this market is looking to go long whilst you're looking to go short, and vice versa. So drawing trend lines, guys, in front of you, you should have on your screens a typical textbook / vanilla trend line to the upside, so a support trend line, an ascending trend line, or a descending trend line, also known as a resistance trend line, and a downtrend, okay? So of course we can use this as a point of reference, and that's all we do within the ITA community. Now, good question, Satish. Now, how do we differentiate? Now, trend lines in the ITA community, and you'll know this, you should know this, or you'll learn this, we conduct top-down analysis on the weekend and prepare our watch lists for the week ahead to ensure we turn from an analyst to a trader as soon as the market's open. Now, in terms of trend lines, there are no wrong or incorrect timeframes to draw your trend lines on. However, the higher timeframes hold the greater weightings and the greatest market structures. So what I do, in order to understand the framework of the market, I always start on the highest timeframes, which is the monthly, moving down to the weekly, through to the daily on the 4-hour and the 1-hour. And I pinpoint areas of framework and market structure. And of course, I take into consideration the weighting of those. So if it's on the daily or the weekly, they're going to hold greater, daily, weekly, or monthly, they're going to hold greater weightings than a trend line on the 1-hour or 4-hour or other intraday timeframes. And of course, what you do and must remember as well is the lower you go down, the less weighting it holds. So of course, you'll find that no one necessarily respects as much of the time an intraday trend line or area of support, resistance level or zone or market structure as one would on a higher time frame structure. So there are no incorrect time frames to draw that on, but the higher time frames will hold greater weighting. So summary and key to take away from trend lines. To draw trend lines correctly, two major points, i.e. top or bottoms, are to be established and connected. 3 touches are needed to confirm a trend line. This is a key as well. The steeper the trend line, the less reliable it is, and the more likely it is to break. Now, if it breaks, it doesn't necessarily mean that we're seeing a trend reversal, be it bullish or bearish, or a change in market cycle. It could be so that it, subject to the characteristics of the currency pair, it could be breaking that trend line to create a deeper correction, such as a bullish continuation pattern or a bearish continuation pattern, and then continue in its direction that it originally come from. I.e., if it was a bullish move and then it's corrected and broken through an ascending trend line support, and it's just created a deeper correction and it breaks to the upside, then of course we should see momentum kicking in and continuing to the upside, as we've seen in gold. And gold has absolutely been rocketing recently. We just had recently Jerome Powell at about 6 o'clock this evening, obviously on the Fed, talking, and he did move the markets. He strengthened the dollar temporarily, intermittently, and we're seeing a little bit of fallout between the euro and gold at the present moment, as we are most asset classes and base currencies that are obviously paired up against the dollar, and of course any counter currencies that are paired up against the dollar as well, such as CAD, yen, etc., etc., etc. One thing that I always like to touch upon as well, trend lines are known to become stronger the more times they are tested, just like horizontal support and resistance. Now, this theory and thesis is somewhat true, but bearing in mind trend lines are subjective. What I also like to say is the more times a trend line is tested, the weaker it becomes. It's kind of like anything, right? If I sharpen my axe and I'm using my axe to fell or cut down a tree, yes, I'm going to hit it 3 times and it's still going to be very strong. But the more times I hit it, the weaker it's going to become. And it's the same for a ceiling, and it's the same for a floor with a hammer. The more times you hit something, the particles are going to get weaker and weaker and weaker until essentially and eventually it breaks. And these are only things to take into consideration. Trading is a very discretionary game. Some of you touched upon it a little bit earlier. You know, it's actually a lot less than that. But since working with particular brokers, what we're seeing is we're driving down the amount of traders that are losing. So one of the brokers we're working with, or had worked with or have worked with, you know, when we started with them, 88% of retail investor accounts lost money trading CFDs with that provider. I think now it's down to about 72%. Now, I'm not saying this is directly influenced by us, but what we're trying to do is drive down the probabilities and the percentages of traders blowing up. The first 90 days is when traders lose 90% of their cash. Now, what we're doing is, the greatest thing is ITA has never had a client blow up their trading account, and about 90-95% of traders are making money consistently PCM, which is a great stat to show off. And of course, it's all down to discretionary, and it's all down to us, of course, trying to provide them with the correct guidance, the correct mentoring, the correct education, and the correct overview, really. And a key to that is working with a broker that is as passionate and has the same purpose, the same values, the same drive, the same charisma, and ultimately has the same outlook, wanting to provide a proficient service with lower turnover on their traders, with greater profit margins and ratios. And once you find a synergy, which we have with ATFX, the synergy is extremely powerful, and together we work extremely well. And a lot of our community work directly with our account manager, David Berg. So David Berg is a fantastic, incredible opportunity in person to be, and he's such an admirable person within their team, and I couldn't rate him enough. So, without kind of blowing too much smoke, chart patterns is where I spend the majority of my time. Now, we differentiate between any old chart pattern and focus primarily on higher probability market structure chart patterns, not necessarily valid ones, and we stick to the 80-20 rule. So, reading over this, guys, feel free. Chart patterns are considered one of the most effective trading tools within a trader's armory, especially within the ITA community. Chart patterns repeat themselves in the markets time and time again, and once understood, are relatively easy to spot. And what I say to our community members is, once you have seen them, it's very hard to unsee them. Chart patterns particularly are formed of pure price action, so they're not subjective, and form on the base of underlying bullish or bearish pressure. The ITA community use chart patterns to identify continuation or reversal signals to execute our trades and identify potential price targets through forecasting and ray lines. I've actually wrote a book. It's called the ITA Chart Pattern Blueprint. This is an extract of that guide. What we do is we focus specifically on what we consider our go-to setups, which are the most common chart patterns utilized within ourselves. And what we do is I'll actually be giving every one of you in the community this evening the opportunity to have a copy of this book, and hopefully it's going to be something that you'll keep throughout your journey in terms of the content and in your journey of becoming a consistently profitable trader within the markets with us, with ATFX. So I'm hoping the value that you draw from me this evening is going to be fantastic. So I've extracted a couple of the chart patterns I look at. So primarily you're going to look at bullish and bearish flags, ascending and descending wedges and the typical uses behind them, and of course bullish and bearish equidistant channels, also known as ascending channels as well. Equidistant channels, which are of course equally weighted lines, two trend lines formed to create a train track, essentially a pattern. So bullish and bearish flags, guys. They're formations that show sideways price action, so an area of consolidation, a phase of distribution, or an area where the markets are correcting. They show where trends consolidate after a bullish or bearish move. And the greatest thing is they're known to be complete after price action actually breaks out and continues in the direction of the prevailing trend. Now I show our community how we trade bullish and bearish patterns, because there are two ways, not just one. And that's extremely powerful. If you understand how to read the market structures and actually trade the market structures, there are two probable entry areas subject to how the market approaches these particular levels. And that's where we delve into nature, guys. And not the nature being, you know, what we see on the television. Expanding wedges. Expanding wedges can either be bullish or bearish, depending on how they form within an existing trend. And it's quite key to understand how to read them when they're in a particular cycle. So if you find an expanding wedge at the top of a trend, i.e. a bull trend, and it's in a corrective phase, this potentially signals that the market's going to be unsustainable to continue to move higher, which is a perfect opportunity to look for reversal signals subject to the price action, of course, and the overall time frame structure, and vice versa. If we're in a bearish trend and we see an expanding wedge formation through corrective price action form at the bottom of the market and the structure, then that is typically seen or viewed as a potential reversals pattern that we're looking to get long and actually buy the market to see it go higher. Alternatively, if it's within an ascending or descending market and it's not at the top of the structures based on the higher time frames, then we look at it as a continuation pattern to continue with the precedent trend or the higher time frames. So that's an expanding wedge. Ascending and rising wedges. Now, I find ascending and rising wedges, now this is a key as well, guys. I don't just draw these structures on the markets. I don't just apply them to all of the majors, the minors and the exotics, the commodities, the crypto markets, the equities, the indices, the fixed income, the rates, the indices, crops. Each asset class has different characteristics, different success and failure rates. Now, I provide you, when you join our community, with backtesting blueprints. I provide you with the information and an overview and guidance, an initial setup session where I'll provide you with how to backtest properly, how to document and journal all of the backtesting to understand the true power of backtesting, understanding how many trades you get in an impulsive leg, how you need to be patient in the financial markets. Now, guys, just a show of hands in actually just a couple of answers for me while I have you on this particular stage. How many trades, on average, would you say you guys take every single month? Mero, Cecil, Daniil, Avio, great answers. Thank you very much. Now, I'm not necessarily saying these are wrong or right answers, because everyone has their own preference in how they're trading. Now, I've traded for 14 years and I've traded pretty much every single strategy style of trading out there, through scalping, momentum trading, swing trading, trend following, straddle trading, arbitrage trading, you name it, price action trading, naked trading, trend trading, breakout trading, top calling, bottom picking, etc., etc., etc. Now, it's all subjective, of course it is, because the market works on its own cyclicity, and we cannot control the outcome of a trade. We cannot control when we trade. Sorry, we cannot control the outcome of a trade, and we cannot control price action. But what we can control is when we trade, time frames we trade, the asset classes we trade, how many trades we take, how patient we're going to be. Are we optimizing for high probability setups 80% of the time and 10 to 20% valid opportunities? I take on average 2 to 4 trades a week. Our other strategies, some of them can take 5 or 10 trades a day, subjective if they're a scalping strategy. Some of them can take 4 trades, 5 trades a week, 20 trades a month. So it all depends on what type of trader you are. Now, the reason I mentioned how long I've been trading is when I first started scalping, it was really hard. But after 12, 13 years, and I started scalping the markets in different ways with all of the knowledge and experience, it does become a lot easier, but it's the quickest way to burn out as a trader. Now, each and every one of us in this room has 5 to 10 years. 5 to 10 years compounding or providing someone with a very, very impressive track record after 12 to 24 months can do some seriously wonderful things to your career and your future. Scalping for me, I don't know, I can't count the amount of scalpers I know on one hand that are in this game long enough, that are sustained at the rate they were doing. But what I always do is I say, look guys, each to their own, but it's great to see how many trades that you all take. Vincenzo, just clarify for me, the audio showing up on my end, and drop a few yeses in the chat. Can everyone hear me loud and clear? Awesome. If okay, Vincenzo, maybe log back out and log out and log back in. Alternatively, do a sound check on your audio, as I can see the majority of people can hear me. So, ascending and rising wedges, I'll touch on the traditional elements and of course the typical elements, and then I'll cover the fundamental elements for you, Eddie, I believe, sir. So, ascending wedges are traditionally and typically known as a bullish continuation pattern, and of course that's whilst the price action remains inside it. However, the ITA community, we utilize this as a reversal pattern. So I haven't drawn a typical textbook price action elements within this, but we're always looking for opportunities to get short a rising or ascending wedge, and we're looking for the evolvement and adaptation of the market. Now, we see ascending rising wedges in a downward trend considered bearish, and of course the ITA community see this bullish trend as a potential reversal pattern, signaling a reversal in the trend's direction. Now, I'll cover what are descending falling wedges. Typical, obviously, whilst price action remains inside the wedge, we believe this is bearish, but bearing in mind, guys, if this is a weekly bearish wedge, there are going to be opportunities to exploit the market conditions and an abundance of trades and opportunities we get on the daily, the 4 hour, and the 1 hour. But what we cannot do, guys, is be too zoomed in on the 1 hour and 4 hour time frames. We must focus on the higher time frame structures due to the greater weighting they possess and they have. But the greatest thing is market moves in cycles, impulse correction, impulse correction, impulse correction, etc., etc., etc. Meaning that if that's the weekly, then inside that you're going to have mini impulses and corrections and vice versa all the way through to the lower degree. And of course we get to exploit these opportunities, have tighter stops, greater risk to reward ratios. If you look back at end of January, early Feb, we had a decent short in dollar CAD for around 21%. Oil last end of May, early June, we took about 6.5% out of oil, but there was an overall about 18% potential reward on that. But of course it does require patience, and when you see the markets move erratically with low liquidity and hardly any volumes due to fundamental news or something along those lines, you have to try and understand and be discretionary and take the trades as you call them and see fit. So yeah, we managed to take 6.4% out of that, and I'm completely happy and comfortable. I don't care that I missed the remaining 12-13% move, because it's not about how much, it's definitely not about how much you make in this game. It's about how long you can stay in this game and how much capital you can keep hold of. But as long as you're consistently profitable, making decent returns, some guys 2 to 4% PCM, that's fantastic when you compound those returns. You know, without compounding, it's 22% a year on the lower end, and it's what, 48% on a year over 12 months uncompounded. But if you compound it times 1.13 annually, then it's fantastic, guys. And of course, if you're looking to withdraw 25% of your profits monthly just to reward yourself, compounding 3/4 of it, still as good, you know. So don't ever worry, and don't ever think you should never reward yourself. So summarizing, both the ascending and descending wedge patterns are commonly used within the ITA community, creating opportunities to get long or buy. Now, the fundamentals behind an ascending wedge, or a descending wedge, very similar to trend lines. Once we can establish 2 touches, 2 points, both on the support and resistance level, then of course we're forecasting for the wedge to get tighter and tighter in towards the apex. Sometimes the price action will move outside the wedge, and that's where we evolve our trend lines and framework to create an equidistant channel, be it an ascending or descending, guys. So have a read over that. Typically and commonly known continuation patterns within the uptrend. Obviously, whilst price action remains inside a bullish, it remains inside an ascending channel, it's bullish. And of course, in a descending channel is bearish. But what we do within the ITA community as well is we're again typically looking for not only continuations within inside these, but we're looking for patterns within patterns, reversal opportunities where we can exploit potential changes in cycles. Now, we're not trying to call the tops or pick the bottoms, guys. But what we're looking at doing is potentially looking at high probability areas where the market is looking to reverse in trend and cycle. As PTJ, one of the greatest hedge fund managers in the world, which is also short for Paul Tudor Jones, says the greatest money can be made at turning points and changes in cycles. Yeah, Jean-Pierre, info at intelligenttradingacademy.com. That's my email, so I'll pick that up probably tomorrow now for you guys, and I'll get in touch with you and send over a copy of the ITA price action cheat sheet for you all to print out. I'll show you a copy of it later, and hopefully we can go from there. So chart patterns, again, equidistant, descending and equidistant channels are obviously what we're looking for here. Now, let's quickly move over into the price action cheat sheet, guys, for you all. And then we'll jump into the charts and look at some potential opportunities. So this isn't the greatest version. I've had to scale it up quite big, but obviously this is typically price action in its greatest form. Now, our trading strategies use the 3 elements as well as discretion and a few other keys: market structure, nature, price action. Price action is formed up of candlesticks. Now, we don't use any other candlestick other than the traditional Japanese candlesticks. What we do sometimes is remove candlesticks and actually put it onto a line chart, just to show you the differentials and try to shut out as much noise as possible. We don't use point and figure, guys. Point and figure is probably one of the oldest, and although it's very powerful, it's quite hard for newer traders to understand. I know Adrien used to use PNF charts many years ago as a trend follower, but typically these are the price action go-to chart sheets and setups that we look for. So we look for the doji, looking at the bullish engulfing and the bearish engulfing. So bullish engulfing, it's really self-explanatory. The hammer, so the hammer is found at the bottom of a bearish trend or a descending market like this. Typically, it's better to obviously see green. So if your candlesticks are traditional green for going up, i.e. bullish, red for bearish going down, ideally we want to see a green close over a bearish close, because that still shows some sign of bearish strength and a little bit of indecision. The opposite of that is a shooting star. So a shooting star is found at the top of a trend, so at the top of a bullish trend, and it's usually where the candlestick has rejected the upper channel of resistance, or price is exhausted through unsustainable moves, be it impulsive or corrected. Ideally, the wick needs to be at least 2 to 3 times longer, and of course the body ideally needs to be red. If it's green, it doesn't necessarily mean it's a failure, but it's obviously less higher probability. Similar to engulfing, you've got the bearish army and the bullish armies, which of course signals that the previous candlestick is greater than the bullish, but this still does signal the opportunity for further downside. But there are, just by knowing the candlesticks and pieces of price action, guys, it doesn't necessarily mean you take that trade as soon as that is printed in price on the markets. You have to understand how to trade these things, guys. And that's where ITA's 40 plus years financial trading experience from the institutions and professional games that we've played in for the last 4 years comes into play. And that's where we can hold your hands as much as possible with ATFX. Hanging man, same, again, found at the top of a bullish trend, i.e. the same as a shooting star. It's just obviously the flip side. Ideally, we want it to be red because it's at the top of a trend. It does just what it says on the tin. It's a hanging man. So the red body of the candle, which you can see here, is the head, and the wick is the neck and body of the particular stick man. Evening star, guys. This evening star and morning stars are one of my favorite formations overall, and again, there's self-explanatory. Bullish move in, very corrective candle, then a bearish move to the downside, and this is where we'd be looking to take that short on the close of the third candle, and it obviously it has to be at least half down on the first candle, so the original green impulse candle, and for this one, the original bearish impulse candle to the downside, with obviously the bearish indecisive corrective candle. So this suggests markets moving down, this suggests markets moving up. In terms of the weighting of the candlesticks, again, the lower the time frames, the less weighting and prominence and prowess they hold within the marketplace. They're still readable, they still hold weighting, but not as great a weighting as you would find it on the daily, weekly, or higher time frames. I don't use the bullish kicker or bearish kicker as much, nor do I use necessarily the dark cloud cover or the piercing pattern. Inverted hammer I do. So inverted hammer are usually found at the bottom of a bearish or descending trend. Green is the best because, of course, being at the bottom, we want to see bullish markets being moved or a potential trend reversal like that. It's literally, as it says on the tin, markets move in, bearish correction candle, a bit of indecision is shown, and then of course we're looking for the markets to move higher. So take your time just to read this. All of these signals are best after a long and strong trend. Utilizing a stochastic indicator will increase results. In most cases, a strong candle in the opposite direction of the trend after the signal candle is preferable to verify the reversal. Now, one point I'd like to make, I do not use any oscillators or laggard indicators or other indicators than what I'll be showing you this evening within this trading strategy. I don't use stochastics, okay? So without further ado, guys, I'm just going to take a couple of questions, but then I'm going to delve into the charts, and I'm going to cover maybe the DXY, I'm going to cover US oil, I'm going to cover a couple of other pairs. If you've got any current pairs that you're looking at and you're interested in me covering, please shout them out as much as possible. I'm happy to do as much ad hoc analysis as I possibly can and pinpoint a few areas of nature, market structure, and price action so that each and every one of you can delve in. But I'm just going to pause the audio. You guys can ask a couple of questions. I'm going to have a quick sip of my water, and then we'll dive right back in, guys. So feel free to ask as many questions as you can, and then I'll cover them for you with the information I have. Thank you for the questions, guys. Some really cool ones coming in and some decent pieces of analysis for me to conduct. With regards to the stochastic indicator, yeah, of course I can. Give me a second. Let me see if I can get the stochastic indicator up on the screen. Let's have a look. So this is the stochastic indicator for you guys. Now, there's two ways to look at the stochastic indicator. Many of the typical traditional ways to use it are they're looking at the overbought and oversold areas, utilizing from the level of 20 to the upper bands of 80. Now, so many new traders as well actually trade the stochastic indicator incorrectly. If I can, how do you think, guys, that you trade the stochastic indicator, and then I'll cover it all for you. So I just want to get some ideas, if anyone knows how to trade it correctly, and then I can actually either help you, assist you, or confirm that you're correct. Yeah, very similar, Miro. So how you typically view the stochastic indicator is the following. So the majority of traders actually believe that when it enters into the oversold or overbought conditions, that's when many of the individuals actually look to get in the market. But that doesn't necessarily assist you in creating profitable opportunities, because it can stay oversold or overbought for days, weeks, months, a prolonged period of time. Some individuals like to pair them up with other laggard indicators or area of subjective support and resistance, where they're looking at combining and piecing those pieces of tools together. One of the best ways to trade the stochastic indicator is not when it enters overbought or oversold, but when it actually exits overbought and oversold. Now, what that would in essence mean is that you're missing out on a potentially large chunk of the move. If you're a trend follower, you're not worried about that. You're not worried about missing the beginning or the end of the move, because let's say the trend is made up in eighths, we're going to miss the last eighth of the trade and the first eighth of the trade. We're only realistically wanting and completely comfortable with our trading plan and go-to setups to capture 6/8. And that's where we can make up the majority of our capital. Now, I mentioned earlier there's three types of market in terms of trending, obviously bullish, bearish, and range bound. But there's also three types of trade. There's long, which is buy, there's sell, which is short, and there's cash, i.e. sitting on your hands. It's extremely important to know when to trade and when not to trade, and of course when you should be in the markets and when you should be out of the markets, because no trading strategy matches with the market cycles 100% of the time. You need to understand that only a couple of trades a year can make your trading year. I've seen guys take 4 or 5 trades in a year, maybe 20 trades in a year, and they've absolutely smashed the returns per annum. And they're always focusing on high probability setups with decent risk to reward ratios. You know, if they're taking, like Paul Tudor Jones, for example, he was saying that you could lose 80% of your trades as long as your risk to reward ratio is at least 5-to-1 minimum. Meaning, if you took 100 trades in a year, you only need to take 20 trades that are of a greater 5-to-1 risk reward ratio and capitalize on those 5-to-1 risk reward ratios in the year to make money every single year. That means that you could lose 80 trades, 80% essentially, of your trades and still be profitable. Put that into perspective, guys. That's how powerful you can be if you trade the markets correctly. So let me just remove the stochastic indicator. I'm hoping that you've all received a decent enough explanation of this. Let me just quickly see if I can remove this off. Can't remember how to do so, so I may actually have to just minimize it until later, until I can remember how to do it. It's not an issue. So let's have a quick look. I'll definitely analyze gold. It's one of the particular asset classes I've been focusing on at the moment. Euro yen, happily do that for you as well. Harman, I won't be able to show you the high probability setups for now, but I can definitely go over that with you at some point. But this is where it's key to understand the difference between a valid setup and a high probability setup. But don't forget, guys, we still take valid setups that are possible, but we like to focus 80% of our attention on high probability setups that are highly probable, because that way we're in trades that are more consistent with our go-to setups, our strike rate and trades are greater. So let's delve into the DXY. So I'll start on the daily time frame, guys, as you can just see some really nice clean market structure at the moment. So I've been looking for dollar weakness across the board since we started to move correctively through this particular area here. I was always looking for that longer term short. So ideally I wanted to get markets back up to that 100 big round number before we did take that big short opportunity. But I was of course looking at how price action moved here. So let's actually zoom in on the daily structure and see if we can look at some areas of price action based on the candlestick cheat sheet. So let's look. Let's look for a really nice setup. Let's say this is perfect, albeit it's a shooting star, but it closed green. As I mentioned, ideally we want a shooting star to close red, so that would have been a better opportunity, but as I mentioned, doesn't necessarily mean that it's a failure if it closes green. So what we've seen is this is what we class as a shooting star. If we're looking to take this short combined with everything else, which we wouldn't have taken this short unless it was the completion of the market structure, but just for now we've actually got the price action in its purest form, and then we've got the close of this candle here. That's actually where we'd be looking to take this short. So let's just give you a better visual. Don't worry too much about where I'm looking at the stop loss at the moment. I'm not actually worried about that. I'm just focusing primarily on where we would have got into the trade. So we would have got into the trade there if we were trading price action in isolation. Now, yeah, we would have potentially had a 3.4% winner. If we trailed our stops, we would have realistically got stopped out for 1.4%. If we were less aggressive, then we would have kept our stop at break even and potentially had the opportunity to capitalize on just over 4.3%. If we didn't take that, then realistically 3.5% is where we would have got taken out based on a manual close after this green candle here signaled that a potential reversal was coming in. Let's take a look back. So head and shoulder reversal and breakthrough channel. So you are correct, head and shoulders is a great market structure, but head and shoulders are only found primarily at the top of a trend. So look at this here, that is textbook. So let's just show you if I can. We've got the shoulder, the neckline, and then we've got the break. Does anyone know the stats behind head and shoulders? So whilst head and shoulders are the most recognized pattern in the marketplace, subjective to the currency pairs, they hold different characteristics, of course. But the head and shoulders pattern is known to be one of the most popular, but it also has the highest failure rate of any market structure. And the reason that is because most people follow it. And I found over the years, yes, it can be a very good visual tool to spot opportunities for be it an inverted head and shoulders or a head and shoulders formation. Knowing that it has a greater failure rating, I don't put too much onus or responsibility onto them, and I don't really look at them. In my opinion, head and shoulders, I still see them, I still can take them into consideration, but I don't put that much weighting on them. They need to be at the top of a trend or the bottom of a trend. They cannot be found in the middle of market cycles. That is not considered the classic textbook of a head and shoulders pattern. Here in particular, yeah, head and shoulders, but look at in terms of the actual head and shoulders pattern, it was a failed head and shoulders pattern. Move down, come off of a key level, which made a double bottom at 93, 94 level, the big round number, and then moved higher. So don't get me wrong, they will play out from time and time again, but they do have greater failures than they have greater successes. But great spot, and I appreciate you're probably focusing on the most recent area, although I don't see a head and shoulders there. This move needed to be a little bit greater, so if this is the area we're thinking about, I would have liked to see this a little bit deeper, move up, create a new peak, come down, and then go. And then we'll of course look for a correction and move all the way to the downside. So moving back into price action, let's see if we can find some really nice textbook pieces. Here on the daily time frame is a morning star, not textbook, but if we can see that, so let's have a quick show here. So morning star formation right here, bearish move in, small, kind of small green reversal candle, then move higher. Really nice move to the upside, which was actually only to correct and to retest the underside of the breakout and create a swing high double top at 94 level, big round number, getting a lot of people caught on the wrong side for a further move to the high. Really nice move to the downside. But this is actually something that we've been forecasting for weeks. You can see this chart structure here. As I move down into the 4 hour now, let me show you this. So daily, so ascending wedge, guys, this wasn't drawn the cleanest. Ascending wedge, really nice move. We've got 1, 2, 3 touches. Shooting star formation, again, not perfect. Really nice opportunity. Taking this short from here. On a daily, it's going to show us about 100 pip stop, but I'll show you something in a second. 90% probability rule when market broke this particular level here impulsively. 90% of the time it's going to get to the correction of the structure for about 3.25% on this particular trade. But let me show you down on the 4 hour what this looks like, if I may. Let's take a look here. I'm going to get rid of this risk to reward tool, and I'm going to show you just how powerful nature, market structure and price action is in the way the ITA community trade it, and I hope you will enjoy it, guys. So let's take a quick look. We started to see this particular asset class moving lower as we got the corrections through here. We didn't let the impulsive move take us off the ball, but this is where we started to see realistically the opportunity to get short. So everyone remembers this particular price action setup here, yeah? Let's just show you again, guys, so you can all remember it. Bearish harami, yeah? See that? Just move that across. Bearish harami, bearish harami. Can you all see that nice and clear, guys? Yeah, apologies. Even though I'm on the 8th floor of our office in London, with thick glass, you can hear a lot of the traffic. Because we're so isolated up in the sky, you can tend to hear pretty much everything because, of course, the noise rises. And it's pretty frustrating at times to time. We've got a brand new development apartment blocks, and maybe the next month's one or next week's one I'll do a recording, and I'll actually hopefully get a webcam, and I'll just show you. Sometimes throughout the day you can hear the construction workers working and digging out the foundations, but something's obviously going on out there, guys. We're only just around the corner from St Catherine's Docks, I hope you all know. But I actually put my screens up against the glass so I don't get to look out, but I have my back to pretty much the gherkin, the walkie-talkie, the cheese grater and the like. So yeah, I don't want to get distracted by it, and it becomes a bit of a distraction after a while. So let's get back into the charts, guys. So if we actually look at this here, now this all comes down to discretion, but just by moving into the lower time frames, once you've understood the greater structure on the daily time frames, that 3.4% trade has turned into just over 9% with multiple opportunities to scale in. Now that comes with experience, that comes with understanding the go-to setups, but you've got this bull move down, impulsive bearish move down, corrections, impulse correction, impulse correction. Now, the lower the market goes, the lesser quality and lesser probability the continuations become. But once you understand the power of how many opportunities come inside an impulse leg, once you've back tested each characteristics and currency pair, the market structures and price action combined with the nature, so how does it approach that level, really helps you to understand. So 9% on that particular trade, and this was actually all traded, and I can't obviously guarantee that because this is all now taking it back to data in 2018 last year. We had a second trade for 11%, and then we of course had that third scaling. Now in terms of our scalings, guys, we don't just scale in when we want to, we scale in when the market does. But of course that trade could have been a 5%, but we got stopped out for just under 1.5%, just 1.5%, 49 pip stop, and then the overall move banked us about 23-24%. So it wasn't actually a bad set of trades. Sorry, I'm fibbing. I've just got that wrong. Hold up, I just forgot to change this. One sec. 30 pip stop. Move to there. Got stopped out here. So 4% there, 9% there. So we're looking at 13%, maybe nearly 14%, and then 1.5%. And so about 15% we made on that trade last year. So just by looking at this, guys, on the 4-hour time frame, that's the 4-hour time frame. I executed on that, and some of the guys did move down into the 1 hour and 15 minutes, but it will really just give you the power of understanding the differences in the moves. Focusing on fundamentals, so in terms of that, I 10% of the time. So every morning I send out a daily report. I don't have it up, I don't think. I'll show you in an email. I don't have it there. Every morning I send out a daily report to each and every one of our community members. And in that daily report, I'll print the overnight economic news in Asia, the US, the currencies, the commodity markets, and then I'll also provide you with the economic calendar and the forecast for the days ahead, only focusing primarily on the medium and high impact news. We need to understand it, but something that I'll pull into focus for each and every one of you. When we're backtesting, I rarely take into consideration the economic news. So when we're live trading, we have to act with discretion, because when we're backtesting, if we don't take it into consideration, it's not going to necessarily influence our trading results, but it could advance or decline our returns on investment. But when we're live trading, we either need to take into fact, okay, we backtested, we did not take into consideration fundamental news. Or if you did, and you actually deciphered out all of the noise and you did take into consideration the fundamental news, so you weren't trading on particular dates, that would of course be quite menial, and quite, the onus would be on yourself, and it would be quite hard to extract all of the key events when you're backtesting, because there's so many series of events. If you did do that though, then of course you wouldn't be trading around FOMC, RPI data, CBI data, rates changes, NFPs on the first Friday of every month. If you did, then of course you'd be sitting aside. You just have to take it all into consideration. Like dollar CAD, if I actually move over into the dollar CAD chart, the dollar CAD chart last week was a fantastic opportunity for us to all get short. We did highlight it, and we have obviously highlighted opportunities to continue in the US dollar CAD. But if I bring that up for you all now, let's move back out into the daily time frame. Of course, we were looking for shorts around the top of this, about the 135 handle, and we were looking for scalings around the 133, 134 level, about the 18th of June, and that was around the FOMC on that Wednesday. So if you did take that short, then you would have managed to capitalize just off the daily time frame about 2-3%, I think. Let's say you got stopped out here, you would have been stopped out for just under 4%. But if you did take that trade, then fantastic. If you didn't, because of the economic news, you sat aside, you've got to remember, if you backtested and you made a great reward over the year, you did decent returns, when you're live trading, just be mindful of it. I focus on fundamentals 10 to 15% of the time. The remaining elements are all technical based. That's why I call it fusion of analysis, because I take it all into consideration, but I do not let it distract me or deter me from taking a trade if there's a high probability setup. Because Yes, we can get tagged out of a trade for 1 or 2 pips, but we can also be kept in a trade by 1 or 2 pips. So it's a much of a muchness. It's all part and parcel of the game. And whilst I won't enter a trade 10, 20, 30 minutes or an hour before any kind of high impact news, if it's 8 hours a day before, then of course I'm going to look at taking the trade, guys. I'm not going to let it stop me, because what we all must make sure that we take into consideration, and something that I would, if you've got a pen and paper handy or notes on your desktop, news creates volatility. It does not change market structure. So once again, news creates volatility. It does not change market structure. Let me take a look at gold. Now, is that gold against the dollar, or is that gold against euro, guys? Would you like me to take a look at XAU USD or XAU euro, or anyone in particular? Okay, cool. So just so you know that I actually trade both gold euro and gold dollar. So let me quickly get up gold dollar for you. So gold dollar, let's quickly zoom out into the weekly. Weekly, look at this. So this move, obviously huge impulse corrections all the way down. Let's zoom into the daily, and I'll show you the most recent elements of what we've been focusing on. So really nice trades all the way through. Now, I actually see these particular moves becoming quite unsustainable, and the particular question was, how do I view this current breakout? Now, I have been calling shorts on gold since we've had this move up. So very corrective. 80% of it is corrective. And now we've recently had this, of course, move. So I'm just going to revolve my trend line. What I actually see is one more move to the upside. I see a range between 1450 and 1480. What I'm going to be looking for is something like this. So I want to see it move back in, and I want to see it move correctly to the top of the channel. And then I want to see it. I actually want it to move slightly and break the high, because I want people to get long. So I want the herd mentality. I want the majority of people to get long. So break the highs, continue to correct. I'll then rein in this trend line. I'm then looking for a new market structure to be formed. And then at this particular moment, I'm going to be looking for shorts, and I'll be looking to take it from the top of the structures, give or take, when I see some really nice exhaustion, and I'll be looking to the bottom of the correction. I'll be looking for 3%, and I'll be looking for just under 6%, and that's on the 1 hour time frame. So if I can actually get in a lot closer, ideally I'm going to be looking at a tighter stop, but I'm not that bothered by a tighter stop. If I can see how this actually plays out, then of course I'm going to be looking for greater opportunities. But at the moment, I know a hedge fund has been long this from 13.25 roughly, and they've been calling it long. And he was the hedge fund that managed 300 million Australian dollars that I traded for out in Australia. Really cool guy. So, I'm not saying he's right and I'm not saying he's wrong. In terms of my stop loss and take profits, I'm always looking at the way the market structures. I don't necessarily have a fixed stop loss, be it 20, 25, 35, 45, 50 pips. I go on the market structures and price action. And in terms of take profits, I utilize something called the break-even method. So depending on the length of the trade, utilizing on which time frame. If it's a short-term trade, I'll be looking to move my stop to break even when the price is about plus 1% on the trade. If it's a longer-term trade, I'll be more relaxed. In terms of take profits, I have different profit targets. Ultimately, if it's looking at this, so my first take profit would be about here, so 14.32. My ultimate take profit would be 13.82. Now, move out onto the daily. If we can get down through all of those levels impulsively, then of course I'm going to be looking for an ultimate profit taking the correction down at 11.63. But that would signal that dollar strength is coming in and staying. Ultimately, I want to be getting short the US dollar. as I do see the dollar basket getting weaker. But I'll evolve my bias. I stay unbiased, and I'll evolve my trends and trades with conditions of market. So gold, at the moment, I do want it to, well, I don't want it to. I do see it moving higher for that last kind of move to the upside. This move hasn't last played out. We've got a very corrective impulse. We've got the middle section, basically at wave 3. 1, 2, 3, and then I'll be looking for that move to the downside. I would like to see this move. It's the same, but primarily, this is what I've said, guys. This was brought out in news. Yeah, Daniil, I'm hoping that you've been listening through the webinar, buddy. This whole strategy is built around market structure, nature, and candlestick, so price action. So I don't use indicators, as I mentioned. I only use price action, market structure, and nature. So yeah, if you've been here the whole session, you'll have heard me talk about that throughout. But yeah, price action is where we're kind of like the final tick to the box, although I don't have a tick box system. It's where after the corrective price action, I'll be looking to take it and get short, subject to how a particular candlestick closes. So if you look here, we had the evening star formation, bullish move in, evening star, green, take it short to the downside. But you've got to understand how it gets there and where it's come from. So that wasn't the third touch, it wasn't the fourth touch, it wasn't the fifth touch. It has just begun its parabolic move to the upside. So Harman, impulse and corrections are basically at wave theory. Impulsive is all about how the candlestick looks, and corrections are all about how the candlestick looks. So if you're keen and interested, then I'm going to drop a little offer in shortly, and hopefully you'll join the ITA community, and we'll see. And I'll take your trading to another level if I can. If you're open to it, I can hold your hand as much as possible. But if you don't take advantage of the opportunities and the great experience and knowledge we have here, built up over 40 years, I can only give so much golden nuggets away, but I'm not giving any holy grails away, guys. Like, do you know what? Does everyone want to know what the holy grail is of trading? I'll be able to give it to you right now. The holy grail of trading is psychology, risk management, and process. But understanding the process isn't just becoming a consistently profitable trader, it's consistency in all things. It's consistency in your analysis, your rules, your forecasting, your back testing, your daily journaling, your weekly journaling, your monthly journaling, and your trading plan and go-to setups. If you're consistent in those 8-9 areas, in time, when your clock and time is ready, you will become a consistently profitable trader, and you will start to make consistently profitable returns. It's not unknown to make 5 to 15% returns per calendar month. I've seen it where in a quarter 60% is achievable, but I'm not here to over-promise and under-deliver. I'm here to under-promise and over-deliver. Sorry about the analogy, guys. I couldn't get it out. But ultimately, Harman, absolutely fantastic question. I said this at the very beginning of the webinar. Because many of the structures that we're utilizing and looking at are on the higher time frame structures, such as the daily, this is where the beauty of setting alerts and preparation comes into play. When you start your trading, you don't have to be a full-time trader. I know part-time, but this is another question. Quantify what a full-time trader is. I probably spend, now that I am where I am, I probably spend 2 to 4 hours a day in front of the screens, and one of those hours is in the morning forecasting and updating my markets, and one of those is in the evening, and then during the day probably 2 hours. If you've got a job, you have an hour lunch break. Many of you will have a cheeky toilet break where you'll go and check your iPad or your phone as well. A lot of the community members we have additional income streams. They've got jobs, they've got property like I have, and they've got their trading, and they're making 5 to 15% a month with a full-time job. And I'll show you how. And I've given you so much opportunity and information within this webinar for free this evening that, yes, you won't necessarily be able to go away and formulate a trading plan and become a consistently profitable trader, but it gives you insights how we do it and how we have taught over 250 plus individuals how to trade this strategy, this style of trading in this way. And we have a rolling of 50 plus people every time, or every kind of calendar that we do these enrollment events. But trust me, if you can commit an hour or two a day to trading the financial markets, more if possible, and you're that serious about making a full-time living or an additional income stream from trading, it's easily achievable. So guys, Euro Yen, let me just take a look at Euro Yen, guys. It's one of the pairs I haven't traded that much recently, but let's move out into the weekly time frame and look at the structure. So very, very corrective nature, descending, expanding wedge, so the opposite of an ascending wedge, and it's an expanding wedge, which is also known as a megaphone pattern. We've obviously had this move down, corrective move down, and then of course correction. Forecasting how this could play out, and then this is where we forecast all probable scenarios and possible scenarios. We could get this move down, correction, move down, and if it corrects here, creates a double bottom, moves up. Now, I said create a double bottom. Why? Right there. Double bottom, corrective move down, pattern within a pattern, subject to price action and how it's got down there, we'd be looking to get long the Euro Yen. That's the high probability setup. Moving to the correction of the structure, moving to the outer structure, then moving to the correction, and if we can get to the highs, then there's great opportunity there. So what's that? 11% to the correction here, 2 quarters, 7.5, 4, just over 4 3/4 to the correction here, 3%. So moving into the daily, that's on the weekly structure, guys. So this could easily make a W pattern, so a double bottom and move higher. So let's get the candle drawn. This could easily do that. Focus on price action. This is in the middle of the pattern, but look, we've got impulse, correcting candle, then of course we've got the bearish harami moving down. It's tomorrow's candle is going to be the decider. Euro Aussie long. Have a look. I'm not even drawing this while you're here, Miro. So let's take a look. So very, very quickly got the impulse, correction, impulse. So ideally, short term, I want to see a slight move, a short-term move to the upside. As you can see, what I've done is I've forecasted the correction into our framework, which is the ascending trend line support. I'm going to see this move sideways. I want it to break this trend line ever so slightly, get the herd caught on the wrong side to get short. And I want that to move higher up towards that 168 big round number into the outer structure. When it gets towards that outer structure, I want to see it move correctively and create a hover. And then this is where we'll either see it move up, or I'm going to be looking to take this and slam it. So I'm going to be smashing the bids if I possibly can. So short-term long, ultimately I want to be looking for shorts on Euro Aussie in time. I did actually get stopped out for a 1% loss in Euro Aussie recently when I was looking for shorts. At the moment, we're sitting on our hands. But I hope you've actually enjoyed everything here. So I'm going to do something different, and I don't do this a lot. I did it in last month's webinar, and we recently had some fantastic interest in it. So we're actually going to be offering an exclusive limited webinar offer. Usually it's 3 months, but I'm going to be offering 6 months education partnership with ITA and ATFX, access to all of our trading strategies, unlimited access to our midweek market reviews, which are held every Wednesday evening. We're going to get weekly and daily market analysis. So what that means is every week and every day I send you a PDF document direct to your email, the breakdowns of the markets, the economics, the fundamentals, our open trades, our profit and loss. So we actually show you all of the trades that we're in live, showing you how much we're making or how much we're losing. And of course you get access to all of the trade ideas and analysis. Our Pro Trader Skype chat with a community of over 50 plus members with all different levels of experience, where you get to engage. You get invited to our quarterly meetups, which are held in our London head office. Trader email corresponds to both Adrien and myself, and you get online or face-to-face individual assessments and individual coaching sessions. Now, as I mentioned, today's offer only, you're going to be getting 6 months education for the price of free. You're going to be getting a bonus offer of the Ultimate Forex Trading Guide, which is one of the books that I wrote, which is for beginners. It's just an overview of technical jargon and technical indicators and summarizes a lot of the basic information that many beginners get caught up with too much, and they're not sure what leverage is, what ESMA was when it was introduced last year, and technical indicators such as the Fibonacci retracement and ratios, support and resistance levels, simple moving averages, exponential moving averages, trend lines, and so forth. You're also going to get a bonus offer of the Intelligent Trading Academy's ITA chart pattern blueprint, which is another book that I've wrote in PDF form. And again, 6 months education partnership for the price of free. You're going to get those 2 bonus offers. Originally, that's the course cost, £2,995 plus VAT to work with us for 3 months. Today's offer only, I'm going to be offering it for £495 plus VAT. And this is a limited offer for today only. 2 ways to grab the top 10 place. I'm only going to give this away to 10 people. Email info@Intelligent Trading Academy with your name and number. Alternatively, drop a yes in the chat box and I will get in contact with you, either myself or my colleague Adrien, who's our client liaison manager and relationship manager. He'll be in contact with you either tomorrow or Thursday. So if you're very much interested in joining us for 6 months for that limited offer, £495 plus VAT, with those 2 bonus offers, then of course get in touch with us within the next 24 hours. I can't guarantee all of the places because I know last month we took on quite a few people, and I only like to give away a few because I don't want to crowd our community. It's quality over quantity. If you are interested in getting in touch with us after those 24 hours, then of course I can't guarantee the 2 bonus offers of the ITA chart pattern blueprint, the Forex guide, nor can I guarantee 6 months for the price of free, nor can I guarantee that cost. Now, there are a few terms and conditions, but there's nothing else. There's no hidden costs. There's no hidden, meaning you get to work with us for 6 months. There's no upsell. Obviously, we want you to work with our broker ATFX. They're FCA regulated in the UK. They've got very competitive spreads and swaps. They're UK based. They're part of the Financial Services Compensation Scheme. Each client gets segregated accounts, meaning that the client money is held separately from their own balance sheet. Fast and safe deposits and withdrawals, and of course they've got dedicated customer service through our own rep called Dave Berg, who's the head of client relationships there. I'll send out a link to every one of you that joins up utilising ITA's incredible offer. And of course this is me, guys, so that's actually me sitting in front of the screens before I moved our office around. I'm ITAD, I'm a financial trader, analyst and mentor, as well as Adrien Slack, who's MSTA, CFTE, financial trader, analyst and mentor. I'm also qualified in IAD, investment advice diploma, and this is our head office, level 8, 3 Thomas More Square, London, Echo 1 Whiskey, 1 Yankee Whiskey. In terms of 12 months, Miro, yes, we do offer 12 months, but what we like to do is get you in for 6 months first. First of all, make sure you like everything about us. And then, of course, towards the end of the 6-month program, you will get an opportunity to work with us at a discounted rate on our 12-month program as well. So everyone, of course, Cecile, Nadir, Miro, Rob, Angus, Adrien, thank you very much for emailing in or writing in the chat group. I'm now going to go quiet and just wait for a couple of questions from you all, and I'm hoping that you've enjoyed this evening's webinar. And please send me an email with some feedback, questions, commentary, any pieces of areas that I can improve upon. But guys, I hope you've had a wonderful evening. I'm going to love you and leave you. Enjoy your evening with your family, friends and loved ones, and we'll be in touch with every single one of you. So have a lovely evening, guys, and I look forward to questions on email. Thank you very much, Cecile. I'm really glad that you enjoyed it. Avo, sorry for my pronunciation, and I look forward to speaking with all of you over the coming weeks and days, and looking forward to you to joining the community. But have a lovely evening and safe trading.